Are we starting to see a slowdown in capital investment, in trade? Are we seeing any evidence of it yet, or is it really just a matter of rhetoric at this point?
At this point, we're hearing about it in the anecdotal data, but in the hard numbers, even in the survey data, it's really hard to see an impact so far. I think, though, if we do have the tariffs against China implemented, if there's retaliation, if the rhetoric around auto tariffs continues for another month or so and the Trump administration continues to move down that road, then I think we'd probably start to see it show up, at least in the soft survey data, possibly in the hiring data as well.
So in terms of actually pricing this, it's been very difficult. Obviously, there's been a lot of rhetoric. People have got nervous about some of the headline risk. Do you think as well that this week, if we start to see a real step up in terms of actual action on tariffs, particularly as far as China's concerned, that we suddenly start to go, OK, now we actually have a...
Yeah, I think the difficulty from an investment point of view is trying to work out where any of these tariffs might fall. Bear in mind, we actually have quite little detail. There's a lot of headline noise.
Yes.
But in terms of individual sectors, it's really difficult to try and work out who the winners and losers are. The analysis that we've done on the tariffs that we have available seems to us that particularly between China and the US, technology and industrials, that they're the two sectors that stand out as being in the crosshairs for some of these tariffs. But that comes with a big caveat of we don't know a lot about some of the ones coming down the pipe.
But at a very general level, we'll put up a chart now that I've just pulled up, which basically compares MSCI for U.S. versus China. And it's pretty remarkable the extent to which the Chinese stock market has really dropped off as the U.S. market has stayed up. The white number there, that white line is the U.S. market, the blue is the Chinese. Is this as a result of tariffs, of trade, or is it something else?
I think tariffs play a part, but to say that it's the whole picture, it would be an over-exaggeration. Bear in mind that the sell-offs only really began in the last month or two. I think there is some concern, particularly with onshore Chinese investors, about the strength of the Chinese economy. You are seeing the Central Bank of China making some changes, which is suggesting maybe there's some underlying weakness. I think that is beginning to filter through into this the onshore Chinese market.
We know they've been restricting credit to some of the larger firms in particular as well and being a little bit more selective, but we've also seen them cut the reserve requirement in the last week as well, so there's a sense that actually they're getting nervous. And we had the PMIs overnight as well, the manufacturing PMIs, which were a little bit softer here. I mean, but if you price this in terms of growth impact, even for the United States, I mean, we're talking 0.2% of GDP. I mean, it's nothing. It's very difficult to see ultimately what the macro impact is, even at this stage.
It is, and I agree that the first-order impact of the tariffs is relatively small. I think the concern is that you get through these China tariffs, do investors then extrapolate to what's going to happen with autos, with NAFTA, and that's where the concern comes in. Does that lead to a tightening of financial conditions?
And there's also a question, could it have a knock-on effect with respect to monetary policy? Because even as Julia says, China, the PBOC, has been loosening. The Fed continues to tighten. They say they will continue to. I'll put another chart up here, actually, that shows the yield curve versus what's going on. And the white is actually inverted with rate hikes. But basically, what it says is the yield curve has been actually flattening faster than they've been able to raise rates. What are the likelihood, particularly as we look forward to the FOMC minutes, that actually the Fed might just start to say, I'm nervous about trade. We may slow down on the rate hikes?
Well, we've already heard Chairman Powell talk about all the anecdotes that they're hearing from businesses, the concerns there. There is some chance that you get to September meeting, and if you do see a lot of softness in the survey data, perhaps you see some slowing in jobs growth and manufacturing, that they might signal a pause. But the problem with that is, once you pause, when do you start again? Do you have enough confidence to start again in December? So they have to wrestle with the fact that if they do get a little bit less comfortable with the data and signal a pause, markets might extrapolate a very long pause.
Haven't they already baked this into the cake, though? I mean, your read from the last meeting was, despite everyone else thinking perhaps they're a little bit more hawkish with their projections as far as rates are concerned, if you bake in the fiscal stimulus here, actually they're net dovish. Could you not argue ultimately that they've kind of priced a bit of this in already as well in that stance?
It is true that when you look at their projections for interest rates, it does imply a pause at some point along the way. So it is possible that trade is what causes that.
When do we get back to the fundamentals?
I think that's probably a second half of the year story, which we're only like the first business into. So I think what will happen second half of the year. I think we've had a tough first half where sentiment has been battered. It's been battered from trade. It's been battered with the Fed pushing through rates. Oil prices have been moving higher. I think the second half of the year, markets are going to focus back in on the fundamentals, where you've got the S&P 500's valuations bang in line with their long-run average. You've got potentially 30% earnings growth coming through, and an economy that in the second quarter may be growing at as much as 5% by some measures. That is a huge amount of growth for the 10th year of an economic expansion. Get back to those fundamentals, and I think investors start looking a little bit happier.